What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you some upcoming events, some upcoming earnings to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as I do provide daily updates as well to get you prepared for the day and the week ahead in this glorious market. So, are you guys ready to rock and roll? We've had a pretty uneventful week nonetheless. It was a short week. We got a lot of interesting data just in general that is pointing towards a recession. So, we are starting to get a lot of recession numbers nonetheless out of everything that is currently going on. I'm going to go ahead and throw this up here real quick. And so, over the past week, we have to understand that we are prepping for earnings mode, and that will be kicked off this week. So just be mindful of that. But before we get into that, let's go ahead and recap this last week. Now, again, something I pointed out in the last weekly updates, the banking crisis is gone quiet. But you have to understand that just because it's been out of headline news doesn't mean there's not a lot going on behind closed doors. You have a lot of banks that essentially have a pool of money that they typically use this money as essentially to help them rotate loans out of. So it's a normal fund to help them, but also understand that they have been pulling a ton of money out of there. These regional banks in particular, because they have a lot of regional banks. You have to understand hold a lot of the commercial loans, and a lot of commercial loans have to be re-ups like every couple of years. And understand that just a couple of years ago they were going absolutely crazy with almost 0% interest rates, free money, right, is what is being referenced to over the past couple of years. And so now that interest rates have essentially almost tripled what they were, you have to understand that now it is three times the payment. So if your company is not pulling in three times the revenue of what it is, you're going to see a lot more cuts, and a lot of these loans are coming up this year and over the next couple of years. So unless there's a dramatic change in the Fed's decision to start cutting rates, it is going to get extremely nasty. The amount of job layoffs that we're getting are not even close to what they're going to be. So let's take a look at what we currently got. One of the biggest data sets that came out this week was non-farm payrolls. Came out at 236,000 versus 326,000 last week. Now we have to also understand what non-farms. The administration has essentially been putting this up on a pedestal that this is going to be the growth recession and all these numbers, blah, 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 blah. Whatever the case is, it is showing great weakness, and something we've talked about before. These numbers are also very misleading because people can be essentially let go and be on severance packages and still be accounted as employed. A lot of these people are starting to roll off and understand that at first it was the big techs. Now the big techs get essentially longer durations when it comes to these severance packages, but now there's a lot of people laying off, and now there's even more people. And this week we even had McDonald's. They haven't even released the numbers. Essentially, what they've been doing is they've told everybody to work from home for this week. So we are waiting for McDonald's is supposed to have massive layoffs. So it's not just in the tech industry. So you can't just think that it's just tech. It's going to affect everybody, especially when these leases start coming up. And the fact that, again, pointing back to the banking crisis and being so hush hush, you have to understand that the banks, right? A lot of these banks are going to start going under. Right, the amount of assets they hold puts them way underwater, and again, even looking at the current banks, right, in looking at just Credit Suisse in itself, like what they are technically supposed to be doing, they did, and they still folded, and that was one of the biggest banks in the world, right? Everybody knows Credit Suisse, and now it's gone. And so you can't, again, just think it's all over. And then the Fed are continuing to raise rates. Keep that in mind. Understand that the debt to income ratio on FHA on FHA, mortgages just hit all-time high record of 44% versus 41% back in 2008. The amount of debt people are holding right now is absolutely absurd. The savings rate is at 3.7. It was up to like 4.2, coming from like 2. I think it was at 2.7 at one point, and so it's starting to drop back down. Average interest rates. This is crazy. Credit cards is 24.5%. Used cars 14. New cars is 9%. Record debt levels. Look at this. This is total house debt 16.5 trillion. Auto loans 1.6 trillion, and credit card debt is 986 billion. So this is a huge problem. That again, given the current circumstances with continued layoffs, which will continue to happen, and something that I did miss, there is another monetary policy in May. I thought there was one in May, but then I think I absolutely deleted it by accident. But nonetheless, there is another monetary policy in May, so we do have one before June. But I knew there was a gap in between. Here being in April, that we didn't have any kind of monetary policy. So being said, it didn't stop them once we get that SVB essentially when the bank crisis started. We haven't had it didn't deter the Fed from laying off rates. And so now looking into this week, we have core. Now, this is something that is very interesting to watch. We start looking into what's coming into the next week. But to kind of close out last week, we've got a bunch of other data as well that is essentially pointing to recession numbers. And again, layoffs are continuing to be more and more and more. So nothing is stopping there. CEOs are just up and quitting because of the fact that they don't want to deal with what's about ready to come, right? And so nonetheless, coming into this week, we have the core, core CPI, which is going to be extremely important, only in the aspect that it needs to gradually still be coming down. As long as it's gradually coming down, we're okay. But again, big problem. We had OPEC as well. We're not going to really see a lot of big numbers from that as far as inflation, in my opinion. But I think that will come in potentially later in the next report. So you have to keep that in mind. And again, if for some reason the core this week starts shooting back up, that just is going to be absolute panic, right? Because that's the last thing we need. We know we are in a recession. I think people are well aware that we're in a recession. It hasn't been priced in because this whole soft landing and sound and resilient message has been pushed out there that is again making essentially everybody believe that everything is okay, but we're not in an okay state. And this is coming from a permabull. We're not in an okay state yet. We need a bigger thing to break. We have to understand that we are, this machine or engine that we've been running has like no oil in it, and it's burning up, right? And the engine's about ready to explode. Is where we're at. And you have to understand that in this concept, that's what we're dealing with right now, is we are running on like zero oil in the engine, and we think that we're going to make it. We're going to make it, 20 more miles, right? Like you're risking a lot to make that 20 miles. In that more so being that you're pushing it 20 miles, because that would essentially imply that the Fed are continuing to increase rates. And so that is what's causing you to go that 20 miles, right? And so we are in a tough situation, and we need something bigger to break, because the Fed, if the one thing that could fix everything would be for the Fed to lay off, but they can't just lay off unless inflation continues to come down. But there is a very delayed reaction. So we have to watch this week and see where core is and how much of an impact that will be. Now they're forecasting a 5.3, so they're expecting a big drop coming into this next core. So that's what's interesting there. PPI, again, it's not going to be core, could potentially have a big change in direction. So you have to understand that. But in the same aspect, core PPI is going to have more of an intraday move, right? That's why I listed on there. A lot of these data sets are becoming more sensitive again, because of the fact, again, that now we're starting to worry about recession. We haven't priced in a recession. Every big recession that's essentially been quote unquote priced in is when we crash. This is what we need to understand. And the thing that I've been looking for is that I know when you talk about people that analyze the stock market and the economy, right? They go based off of it's easy to potentially see what the outcome is based off of. I'm not just talking like the overall, because if you look like a bare minimum level into things, everything quote unquote is okay. But if you dig down a little bit deeper, do a little bit more research, you realize that things are actually really bad. And so it's easier to project that things will get bad. But you have to understand that how we're going to get there is very different. We don't know what the catalyst will be that will be the tipping point for this whole thing to crater is the problem. And the thing that I try to depict, and that's why I don't project far out, because the market can change. The market could change tomorrow to the bullish side, but you need two major key things to happen. One being that core needs to come way down, like real close to 2%. And you need the Fed to start cutting rates, not just pausing. They need to actually start cutting rates for that to happen. But they don't just cut rates. They need a reason to cut rates. Like something needs to break. And that's why I thought that, the banking crisis that started, again, that's a slow moving black swan that's in the background that could, again, all we need is one article would be the hair on the camel's back that would break everything, and that would just cause utter panic. So this is why it's been so hush hush over the past week or week and a half, right, or two. It's been about almost 2 weeks now, and so we have to understand it since the whole Credit Suisse fallout. So with that being said, core again it needs to continue to come down. That needs to progress. We're not going to get bullish until Fed start cutting rates. You have to understand that needs to happen first, and not just a pause, but actually start cutting rates. And then at that point, also that will help the banks. That's when the banks will be sound and resilient, because they could be fine and dandy and be out of the clear as long as Fed can cut rates. But you have to understand that's not going to happen until inflation comes down closer to 2%. So with that being said, upcoming pivots, monetary policy, there is one in May on the 3rd. So just keep in mind with that. They're still projecting high projections of another 25-point basis move. I don't see that changing unless something breaks again. And I think they're actually trying to press in 2 more now at this point, but we'll see. Again, we have to take it day by day. And this is why I'm saying day by day is so critical, because we don't know. All it could take is that one piece of information. This just allows the whole thing to topple. Then there could be emergency rate cuts at that point, emergency pause or emergency rate cuts. I think at this point, there really isn't going to be a pause. I think it's going to be, oh, no, we need to hurry up and start cutting rates because we pushed it too far. There may be a brief stint where we do pause. I don't know. That's uncertain, but I can tell that what's eventually going to happen is you're going to have to emergency cut rates because I think they're overdoing it to an extent, but also understanding that you have to be very careful because inflation can kick back off, and then that's the last thing you want to do is start cutting rates and then inflation start pushing back up. So with that being said, we'll see there. And then, like I said, core inflation is on Wednesday. And then another big thing from this week is we start earnings and we have banks. And something I kept pointing out is that banks are on Friday. So if there's some bad data or some information that comes out from the banks, sure, it will, if there's a crash on Friday, it happen on Friday, but they can take it in. I'm not saying it's going to crash on Friday, but we're going to paint the scenario that if something really bad is to leak from those reports, that's why I say you need to pay attention to earnings, because sometimes there are. And right now, with just coming off of a banking crisis, these banks are going to be looked at and nitpicked under a microscope to make sure that there is no weakness. And so if there is, and they start causing panic, you have to understand that there's limits in a day, right? If the market drops 7% in a day, they will just close the market, right? And if they can keep that on a Friday, plan it on a Friday, this is why they don't come out with earnings, right? The earnings don't just come out. They only come out like a couple of weeks in advance, so they can strategically place these earnings in for situations like this. So if there's some reason, they can strategically put it on a Friday so they can release them. If it's really bad, the market just starts selling off, they can take it into the weekend, address it, try to calm everybody down, and then try to open the market back up on Monday in hopes that everything is calm. The market will pop back up. We're strong and resilient. And then, you take it from there, but we'll see. Nonetheless, so very, very critical day, and that is in the AM. So before market open, you're going to get all these earnings. JPM, PNC, Wells Fargo, Citigroup, and BlackRock is also on that list as well. So this week right now, you're not seeing a lot of really big. SPX is looking normal. Tesla's looking a little bit normal. Again, that number's kind of more inflated just because of the fact that it had this huge run up. Now it's just kind of been stalled, so it's been slowly tapering down. BA is still high at 7, so value is still very high as far as what the options are pricing in. JPM, again, very not super high like it was when the breaking crisis was going on, but it is higher than usual. So just keep that in mind, again, because there are earnings. So we'll see what happens there. So if there's something bad that happens on Friday in the morning after pre-market, if the banks start really selling off heavy, could potentially take advantage of that situation on Friday after they disclose their earnings. And if it's really, really bad and we just start getting cascading of selling, it could drop potentially more than 5 points, right? We don't know because we have a catalyst, and if there's some exposure of some major weakness there, it could start really selling the market. And so you need to keep that in mind. This is why I do watch these all the time. So with that being said, let's get into the technicals here and kind of see what we got going on. Again, there's not really a lot in. Like I said, they've been filtering a lot of the bank information, so just keep that in mind. So you're not getting everything on the banks, but understand that things are very much still a concern, and understand that credit swaps and everything that are going on, the data is still there showing that there's panic back there trying to figure stuff out. And so we will see again moving forward. Again, this is the banking thing. It takes a little while to play out, but again, my window is still here between June, July. The latest is kind of that window we're looking at, to where this thing, hopefully something kicks off and we get that breaking point so we can pivot from that point. This thing could be dragged out even longer than expected, right? And so you have to take that into account and go off of normal cycles. This is why I talk about you have to always keep in track of your normal cycle, have a baseline of what's normally going to happen. Then you essentially entail the whole thesis and the current market sentiment that's going on. Current market sentiment is very, very bad, and this is what I'm talking about. There's a multitude of different things that can break. And there could be things that we don't even discuss on this channel that could break, and you have to be mindful of that. And if that news article does land, the market could be down 100 points and a couple hundred points very, very quickly, depending on the news of the events that occur. So, but if we can get one big move down, then that would essentially alleviate my fears of us potentially even going lower. But we need that huge move to happen, and then from that point, I think we're okay. That we would essentially find a bottom at that point. And then, not saying the economy would recover, because I think the economy is going to feel this years and years after the fact. We're not going to have no crazy, huge, booming economy for a while, for a couple of years. But that's not saying the market can't start pushing up again. So with that being said, let's look at some technicals. Like I said here, again, the market's been very quiet sideways. And this is something to keep in mind. We are no raging new bull market. So I know that news keeps coming out, and it's kind of just irritating in my opinion. The market sentiment hasn't changed. How can we be in a raging bull market, right? There's nothing different about this chart says anything different. So nonetheless, I'm actually aiming for this zone here, this 38.36. We've hit the top range. I don't expect us to break out. What good information is there to tell me this is going to break out? It's not saying it can't. It could, and it might, right? I don't know. Maybe something plays into the favor of the bulls, right? Maybe something plays in the fact that core drops to like 5 or 4, and that'd be incredible. The market would rip ridiculous off of that, right? And then maybe the banks are sound and resilient, right? That is a potential there's probability that that could happen. And if it does happen, we could get a nice rip up to 4,300. It's not saying we continue back to all-time highs because we still don't know. There's still way too much uncertainty to think that we would continue back to all-time highs. You need to remove the uncertainty before the market goes back to all-time highs. Now it's saying if we get a lot of mixed information that things are mediocre, the market's going to continue to try to push off of that. But we do need to break essentially this 4170 mark, or the 4200, really, to do anything. If we can't break that, we are not in no new bull market, right? Or this thing is going to come right back down to this zone, the 3800, at some point. We hit it and we bounce out of it pretty quick. But again, until we get new information, right? And again, you have to keep in mind, if we price in a recession, we haven't priced that in. That is one thing we have not priced in. We've only priced in cuts and potential pivots. That's why we've rebounded so fast, is because we've only priced in interest rates. It has nothing to do with recession, right? Everything is fine and dandy in the recession front. We're not going to have a recession, is all you heard for the past couple of years, right? So again, once that a real recession is priced in, then you will see a drop. Till then, we continue forward. But there's a lot of signs essentially showing that we are there. It's starting to price in a recession, because you're starting to see gold push up, and quite a bit, right? This is a recession move. People thought this was going to happen right during after the pandemic, and it actually, to be honest, it didn't really do much at all. It kind of just chopped during the pandemic. At peak, kind of roughly around 200, and then kind of just really just chopped. So we'll see here if that's the case. Again, that 200 market on gold, or close to 200. Yeah, the 195 has kind of been a very big wall. So might get a little bit of a run there. Who knows? We'll see, right? People are starting to fall back to gold. So just keep that in mind. That's recession fears, right? Bitcoin is pushed up a little bit, but it can't break that 30K mark, right? It needs to break the 30K mark. Aside from that, I don't think it's going to decouple from the market. There's too much uncertainty in everything. And it's really hard to really tell that it's going to decouple until the market starts to sell, the market starts to crash. Will Bitcoin go with it? And normally when there's that much fear, it doesn't matter what industry you're in, what market you're in, everything sells. So again, we'll see what happens in the next couple of months. But Tesla, again, heavy selling again this week. Earnings is towards the back half of the month, so we'll see. It needs to roughly break the 177 for this thing to potentially get back down to 140. Again, depending on what the market looks like when it's sitting around for 140, we'll see if that's a higher low or it's going to be a new lower low. And then you need to break below the 100 for it to be a lower low. But we'll see. Again, depending on how the series of events unfold, will really determine what happens there. Again, it cannot break that essentially the roughly around that 210 mark. It's really struggling there, but we'll see what happens. Again, it's just right now it's just chopping like everything else. It needs answers. Until it gets answers, it's not really a lot that's going to go on. BA, again, continue to chop, can't break essentially the 217, and roughly holding that 191. So that's the tight range you're going to sit in until something changes. We even remove this zone. This zone doesn't even need to be here, to be honest. This is the weekly, though. So we'll see what happens there, but it's playing this range here to get really bad news and really good news, and just chopping. The market's not going to let it break out until it figures out what's going on to either side at this point. And the same with JPM. I'm still waiting for this gap to be filled. Still waiting for a 110 check on JPM. Maybe that's Friday. Maybe they get some bad information or exposure that sends them down there. And GS still really weak, but it has hit a point to where it could pivot and start pushing up. Same with the Bank of America. It sold off enough for it to pivot and start pushing back up. But again, we'll see. We'll have to see how Friday does play out. And how normally the banks, the day of that the banks report, normally it's a big day because it kind of projects what is going to happen. but you have to understand that it's not going to be, it doesn't really have like huge intraday moves. But considering that we have, this is why I say sometimes, depending on the circumstances, some things will have more weight than normal times. And right now, considering we just had a bank crisis, or two of the biggest banks in the world in history have gone down within 2 weeks. Again, should be concerning. It's been quiet for about a week and a half. So that being said, there'll be a lot more eyes on what's going on with the banks. So it could be very pivotal on what happens during those earnings. But again, we will see. So again, they've been scrambling, trying to fix stuff because earnings are just, again, around the corner. So you have to keep that in mind. They've had about 2 weeks to try to fix any issues. And a lot of the different issues that they've been fixing have been last minute issues that they've come right up to the last minute to get these things signed off. And so you have to keep that in mind. So with that being said, that's pretty much it. I don't want to make this video too much longer. Again, there's a lot of things coming into play here. You got to be very, very careful. As long as you have risk management, that's what matters. You have to understand that I'm not trying to fear monger here at all. What I'm trying to do is point to the very obvious facts and data you should be paying attention to. A lot of these reports are manipulated, and it's probably worse than what's actually reported, to be honest. All right. And understand that these jobs reports, people working multiple jobs still keep up with inflation. Inflation is still high. Even if it comes down to 5.3, like they're saying, it's still very high. Rental units are still very high. Interest rates are still extremely high. We're in a rough spots, right? And people, that was another interesting thing that came out too, is a lot of people didn't report any kind of crypto gains, which is crazy because a lot of people made a lot of money last year in crypto, and people aren't reporting gains. So very interesting indeed. So with that being said, go ahead and drop a like, throw down a comment what you're looking at this week, and I'll see you guys out there on the field.